Evening, everybody. I'm Ashish Shanker, Deputy Managing Director and Head of Investments at Motilal Oswal Wealth Management. It's really a pleasure to welcome you to another version of our Vantage Point, which is the Masterclass series, where we host business leaders, we host prominent writers, and other experts to give their perspective on what's happening all around us. Today, I can tell you we have an ultra special guest. I am a big fan of his writing. I have read most of his blogs. He is none other than Morgan Housel. He's a partner at Collaborative Fund, which is a venture capital firm investing in young companies which make an impact in the world. He's won several accolades for his writing, and he's written 3 books, the culmination of which I think is his book, which is recently released, called The Psychology of Money. What he writes is at the meeting point of psychology, markets, economics, and history. And he writes it in such a simple manner, and he makes complicated subjects so simple to understand. It is really a delight to read whatever he writes. So without further ado, I will get out of the way and hand over the session to Morgan. He's going to be making a presentation to all of us on his new book, which is already a bestseller. And after that, I'll have the pleasure of speaking with him. Please post your questions on the Q&A box. I will try and curate them and ask most of them to Morgan once he's done with his presentation. So welcome to all clients of Motilal Oswal Wealth Management and thousands of people who are probably watching us on the live stream in YouTube. So Morgan, welcome, and I should say good morning.
Thank you so much. Thank you for having me. Good morning from me. Good evening to you. I really appreciate you having me. It's an honor to get to speak with you this morning for me. I'd like to spend the next 20 or the next 20 minutes or so talking about my book, The Psychology of Money, which is out in the United States this week. It will be out in India 1 week from today. It's a different publisher, so they had a different launch date. So on the 18th, it'll be out in India. And I want to start today with a story that had a big impact on me during my investing career. I'm going to share my slides here for one moment. Just bear with me while I get these. Oh, looks like I'm not able to share my slides. I think the host needs to allow me to do that on Zoom's end. If you could enable that for me, that would be great.
Morgan, I have enabled it.
Okay, thank you. Let's see. Here we go. Thank you very much. And I'm just going to start this. I just want to start with a story that had a big impact on me during my investing career. I started writing about investing in 2007, which was kind of the peak of the global financial crisis, the beginning of the financial crisis that really shook the world thereafter. And so most of my writing career had to do with what caused the financial crisis. What led people to those behaviors? What caused the decisions that they made? Why did politicians and policymakers do what they did? Have we learned from our mistakes? Will we do it again? Those are the questions that I wanted to answer. And I was really looking for those answers in economic textbooks and financial textbooks. And I could not find the answers to those questions, really basic fundamental questions that had to do with why this thing occurred. And I came across 2 stories in 2010 that really had a profound impact on me. It was a story of 2 investors, neither of whom knew each other, but they had this really interesting way that their paths crossed in a unique way. The first investor is a guy named Ronald Read. Ronald Read has about the most humble background that you can consider for someone in the United States. He was a janitor. He would mop the floors. He worked as a gas station attendant, pumping people's gas. He lived by himself for most of his life in a very small house. He was the first person in his family to graduate from high school, but never went to college. Very humble man who did not seem like he had that much going for him financially or economically. And Ronald Read died in 2010. And when he died, his friends were shocked to learn that he left $7 million to charity, to his local college and a local library. And people said, where did Ronald Read, this janitor, get all this money from? And they started digging through his papers, and they realized there was no inheritance. There was no lottery winnings. What Ronald Read did is he took what little money he could save from being a janitor. He invested it in dividend-paying stocks, and he held them for 50 years. And that was all it took to have this janitor turn into a multimillionaire philanthropist. Several weeks after Ronald Read died, a guy named Richard Fosconi filed for personal bankruptcy. Richard Fosconi had almost the exact opposite upbringing of Ronald Read. He was born into a wealthy family. He went to Harvard. He went to the University of Chicago, went to work on Wall Street in the 1980s, and truly became one of the most successful men in global finance. He was a vice chairman for Merrill Lynch. He retired in his 40s to pursue charitable activities. That's how successful he was. And he went bankrupt shortly after the financial crisis. He told the bankruptcy judge that the financial crisis had completely wiped him out. He had no income whatsoever left over from the financial crisis, that he had been wiped out. And what was so interesting to me about these two stories, reading about these two stories at the same time, is that there is no other industry where those kind of stories are even possible. There's no other industry other than investing where someone with no education, no background, no experience can at the same time vastly outperform someone who has the best education, the best background, the best experience. It doesn't happen in any other field, but it happens in investing. And this was sort of my answer to why the financial crisis took place. Why did people do the things that they did? The answer is that I could not find in an economics textbook. What I slowly started to realize was that investing is not the study of finance. Investing is a study of how people behave with money. It is a story about your relationship with greed and fear, your ability to take a long-term mindset, how gullible you are, who you trust, who you seek your information from. Those are not analytical topics that we tend to be taught about in finance and economics. Those are behavioral topics. And what is so important and to me interesting about the behavioral side of investing is that a lot of other fields are also behavioral fields. Psychology, sociology, politics, medicine, all these other fields that have nothing to do with investing, they also study this, fall under this umbrella of how do people deal with risk and uncertainty and greed and fear. And that's what investing is. That was a big kind of light bulb moment for me over the last 13 years, was A, realizing that investing is primarily a behavioral driven activity, and B, realizing that lots of other fields have to do with behavior. So there are things that we can learn from other fields that can teach us how to become better investors. So I want to share with you just a few stories this morning, two stories, neither of which have anything to do with investing, but both of them I think have a really clear and very important takeaway about how we as investors can think about risk and think about our own financial goals in a more practical way. The first story I want to tell you about today, the first point that I want to make is that timing is meaningless, but time is everything in investing. And the story has to do with ice ages. Again, nothing to do with investing, but this will all tie back to a very important investing point. We have known that 5 separate times during our planet's history that the planet has frozen solid. There's been an ice age where the entire planet Earth turns into a giant ball of ice. We've known this for centuries, that this has taken place. We've also known for many centuries that the reason this takes place is because the world's axis tilts closer and further away from the sun. That creates these ice ages, these giant climate changes. Now, for centuries, it was assumed from climatologists who study these that the actual cause of ice age, the dynamic that got this process going, was brutally cold winters during these climate change periods. Winters would become so cold, so snowy all over the world that the entire world would freeze. It wasn't until about a century ago that a group of climatologists in Serbia realized that that was not actually what was causing ice ages. It was actually the opposite. What was causing ice ages was actually this. You would start with a cool summer where the winter snow would not melt. That was the trigger that got this going. Because what would happen is after the cool summer, if the snow did not melt, it would stick around for the next winter. And then there was a larger base of snow next winter, which let more snow accumulate that next winter. So when there's more winter snow accumulation, then there is less summer snow melt the following summer. And then you get this cycle, around and around it goes. You start with a cool summer where the winter snow doesn't melt, and then it just starts layering on top of each other. It starts compounding. Now, it is not intuitive at all to think that you could start with the normal planet Earth, and then you have a cool summer. And then the next thing, tens of thousands of years later, the entire Earth is covered in ice. That is not an intuitive thing to think about, but that is how compounding works. Compounding, even if you understand the math behind it, even if you are a smart person, the intuition of compounding is not obvious to grasp because it is not intuitive to think that a very small, seemingly meaningless change can have such a profound impact on your outcomes. And that, of course, is also true in investing. Let me show you what I mean by telling you a story about Warren Buffett, the most successful investor of all time, one of the richest men in the world, of course. This is Warren Buffett's net worth by his age, by how old he was, going back to age 14 when he first started really saving money. And two things I think should stick out from this chart that are really important to our story about compounding. One is that Buffett was pretty wealthy when he was young. By the time he was in his early 30s, he was already a millionaire, which if you adjust it for inflation is more than $10 million in his early 30s. So he started young. He started investing at age 11, and he was consistently doing it so that by the time he was in his 20s and 30s, he was already very wealthy. The other thing that should stick out is that the vast majority of Warren Buffett's net worth came in his elderly years. By the time he was 80, or let's say by the time he was 70, he was worth about $15 billion. And now by the time he's 90, he's worth about $90 billion. More than 96% of Warren Buffett's net worth came after his 50th birthday. More than 90% came after his 60th birthday. Now, again, what's so interesting about this is that Buffett started investing at age 10 or 11, and he continues to go through age 90. Now, let's do a little thought experiment to think about a hypothetical world in which that was not the case. Let's assume that Warren Buffett started investing when he was 25 years old. And let's assume that he retired when he was 65 years old, like an average normal person. And let's assume that he earned the same average annual returns during that period. He was just as successful, just as talented an investor as he has been. But let's assume he started investing at age 25 and he retired at age 65. What would his net worth be today if that were the case? The answer might shock you. It's not 90 billion as it is today. It's about 12 million. 99.9% less if he had just started investing a little bit later and he retired at a normal age. The takeaway from this is that we can tie mathematically 99.9% of Warren Buffett's net worth to the amount of time he has been investing for, not his investing returns, just his time. Of course, Warren Buffett is a very talented investor. His skill is investing, but his secret that has made him a household name is time. If Buffett started investing at 25 and retired at 65, you would have never heard of him. No one would have ever heard of him. He would have been a wealthy guy who may be playing golf right now, but he would not become the investor he is. Now, what's so important about this that gets back to investing, to compounding not being intuitive, is that if you go on Amazon.com, there are 2,000 books that are in some way devoted to answering the question, how did Warren Buffett become as successful as he is? And they go into great depth and great detail about how he thinks about moats, how he thinks about business models, how he thinks about market volatility and economic cycles. Very few of them will point out just the fact that we know the answer of why he's become successful. It's just the amount of time he's been investing for. That is his secret. But I think that often goes overlooked because it's not intuitive. Even by very smart people who are professional investors, it's not intuitive or it's too simple. It's too basic to take seriously. But we often have to remember this. Most investing mistakes come from asking the question, what will happen next? What's going to happen this month or this year? What's the economy or the stock market going to do next? That's where most investing mistakes come from. Most investing fortunes come from the question, how long can I stay invested for? That's it. And whether you are an individual investor or a professional fund manager, the single best thing that you can do to improve your performance, to improve your wealth and your returns, is to lengthen the amount of time you are investing for. So much of investing just comes down to your time horizon. And again, it's not simple, it's not intuitive, but it is the single most important part of investing. The second story I want to talk to you about today is that risk is what you don't see. And again, I want to tell you a story that has nothing to do with investing. The story is about the famous magician, Harry Houdini. Now, Harry Houdini, who did most of his performances about 100 years ago in the United States, became famous for his escape acts. He could be tied up in chains, as you see there. He would be tied up in a straitjacket, and he would bury himself under water or under dirt, under sand, and he would dig his way out. He was an escape artist. But he had another trick that audiences loved that he became famous for as well. Harry Houdini was an amateur boxer before he became a magician. And one of the tricks that he would do during every performance is he would invite the largest, strongest man on stage, and he would tell that man to punch him in the stomach as hard as he could. Give it everything you've got. And Harry Houdini's claim to fame is that he could flex his solar plexus in a way that would let him withstand the punches of the strongest man in the world. Didn't matter how hard you punched him, he could take it, wouldn't knock him over, wouldn't even hurt him. That was a trick that he performed. Now, one day in about 1920, Harry Houdini did a performance in Canada. And after the performance, he was back in his dressing room, and a group of students who watched the show came back to talk to him. One of the students, his name was Robert Whitehead, walked up to Harry Houdini and unannounced started punching him in the stomach. He didn't mean any harm. He thought he was just performing the trick that Harry Houdini often did. You were allowed to punch him in the stomach. He thought that was the thing. Harry Houdini was not prepared for these punches from Robert Whitehead, and he doubled over in pain. He fell to the ground in agony, and he said, "What are you doing? Why are you punching me?" Robert Whitehead said, "I thought this was part of the trick." Harry Houdini said, "I was not prepared for your punches. On stage, I need to prepare for it, but I was not prepared for this, and now I'm in a lot of pain." Harry Houdini woke up the next morning in excruciating pain. His appendix had burst from the punches, and Harry Houdini died. That was how he died. And what's so interesting about this to me is that Harry Houdini could survive virtually anything. You could tie him up in chains and bury him in dirt, and he could survive that. That was no problem. But the one thing that he was not prepared for killed him. The students' punches killed him just because he was not prepared for that. The really important takeaway from this that is so applicable to investing, especially in 2020, is that how risky something is depends on whether you are prepared for it. People can handle a lot of problems in life if they see them coming, if they are prepared for them both financially and psychologically. But in economics, the biggest economic risk is what no one is talking about. Because if no one is talking about it, no one is prepared for it. And if no one is prepared for it, its damage will be amplified when it arrives. This has always been true, but again, this has been so crucial and important in 2020, because for the last decade, we in the United States and around the world had a debate on what the biggest economic risk would be and who would cause the next economic recession. Who was the biggest risk in the economy? And we debated, was it this guy? Was it Ben Bernanke, the former chairman of the Federal Reserve? Was it his policies after the financial crisis? Was he the biggest risk to the economy? Was it this guy? Was it Barack Obama? Was it all the stimulus packages that we had? All the tax hike that we had in 2013? Was that the biggest risk? Was it this guy? Was it Donald Trump? Is it the trade wars that he's been putting on? The erratic policies that he has? The answer was no. None of those three were the biggest risks. Those are the risks we were talking about, but those were not the biggest risk. The biggest risk that was going to threaten the economy was this guy. It was COVID-19 that nobody saw coming, no one foresaw until it hit the global economy. The biggest risk that we faced was a thing that no one was talking about, that no one could see coming. And again, I think it is always that way. If you look at historically about what investors talk about, the risks that they talk about things like, in recent years, Donald Trump's trade war. They talk about next quarter's earnings in the stock market. They talk about budget deficit forecasts, the looming elections, both in the United States and around the world. Those are the risks that we talk about and analyze and think about. But if you look historically at what actually moved the needle, what was actually the biggest risk to economies and stock markets, it was things like COVID-19. Like Lehman Brothers could not find a buyer in 2008, so they went bankrupt. September 11th, as we're having our anniversary today. Pearl Harbor, that got America involved in World War II. It was these things that no one could have possibly seen coming until they happened. Those were the real risk. It wasn't what people were talking about. It was what people were not talking about. And that is always the case. And then so for investors, you come to this question of, what do you do about that? How do you live in a world in which the biggest risk is the thing that we are not talking about? And there's two things I want you to keep in mind that I think can help get the psychology of what you are doing in investing in a better place on this topic. The one is, think about risk in investing the way that California thinks about earthquakes, which is that Californians have expectations, but not a forecast of an earthquake. If you live in California, you know with certainty that there's going to be a big earthquake in your future, but you don't know exactly when. You don't know where. You don't know how powerful it's going to be. So rather than forecasting the next earthquake, they just have an expectation that it's going to occur. They're always prepared for it. They build their buildings so that it is always capable of withstanding an earthquake. They have plans and preparations to deal with an earthquake at any time, whenever it comes. And I think we should think about risk in the economy in the same way. Rather than trying to forecast, when is the next recession? When is the next recovery? When is the next bear market? I think a much better way is to just have an expectation that those things happen in the future. We don't know when, but we should be prepared for them to occur at any moment. Having an expectation rather than a forecast is the right way to think about risk in the economy. The second part to bring up is just the importance of giving yourself a wide berth, having room for error, and realizing the difference between getting rich and staying rich. They are two very different things. Getting rich requires taking a lot of risk, swinging for the fences, being really optimistic about the future. Staying rich is a totally different skill. Staying rich requires kind of a pessimism, if not a paranoia, about the short term, about being able to survive the recessions and pandemics and downturns, to make sure that you can give yourself enough endurance that you can stick around and enjoy the long run. I've often said that people should save like a pessimist. You want to save money like a pessimist in the short run, but invest like an optimist. Those are two different things, but it's really important to tie those two things together. Those are the two stories that I wanted to talk about today that both come from my book that I think are really important, and just about further understanding the psychology of investing. That some things are not intuitive in investing, but they are so very important. And that if we want to become better investors, have a better relationship with greed and fear and risk, then by and large, what we do not need to do is think about investing through an analytical lens of charts and formulas and data. It's not that those things are not important, they are. But the single most important thing that we can do to improve our results as investors is to have a better understanding of the psychological side of investing. Because you could be the best stock picker in the world. You can be the best economist in the world, the smartest mathematician in the world. But if you lose your cool in March of 2020 or in 2008, when the economy is falling apart, none of it matters. So the psychological side of investing is so important because it has the ability to neutralize the analytical side of investing that we tend to spend so much time focusing on. So I'm going to end my screen share there. I'd be happy to have a conversation with you for the next 30 minutes or so. And thank you very much for listening.
Thank you very much, Morgan. That was amazing. I really love the way you sum up such complex topics into 2 slides. So thank you very much for that.
Thank you very much.
So let me start with a question or a subject that you've spoken many times in your book and through your blogs, which is planning to fail. I mean, you make a plan and it can fail. So there are, and you did allude to it in your presentation as well. Now, one aspect of that I wanted you to elaborate on, apart from room for error, is you also mentioned that you change over time. Your desires change. So could you talk to us about it, and how does somebody accommodate for that?
Sure. Yeah. Let's take both those parts one by one. The first, in terms of preparing to fail, is really important, because all investing is realizing that there are no certainties in the world. There are no certainties in the future. The best that we can do, and what we are aiming to do, is put the odds of success in our favor. That's the best we can do in investing and thinking about the future. Not just investing, but for a lot of things in life. Trying to put the odds of success in our failure, and realizing that since the odds are less than 100%, there is a chance, not just a chance, but almost a certainty, that at times things will work against us. If you have a 90% chance of success doing something in life, then by definition, you're going to be wrong 10% of the time. That's just how the odds work. Even if it's a good bet, a smart bet, that's how it works. And this is really important in investing, because if you look at stock picking over time, that's when the odds of success, of course, can still be in your favor. That's why people do well over time. But success, if you're a stock picker, might mean that you are right 60% of the time. That's if you're good. That's if you do a good job. And so if you were to make 100 investments, and every one of those investments, you go out of your way to do a lot of analysis, a lot of research, you have a lot of confidence in these investments, a picture of success would be that 30 or 40 of those 100 investments that you make don't work out. A lot of them will fail. That's what we see even in a diversified index fund. Over the period of 20 or 30 years, 30 or 40% of the components in an index fund will fail. But that's okay, because a small portion of the other components in the index fund account for virtually all of the gains. That's what we've seen in both the United States and around the world. And again, it is not intuitive to think that you can make 100 investments, be wrong on 40% of them, and still do really well. It's not intuitive, but that is how the odds of investing work. It's something to keep in mind. The other thing about you will change over time is really important. Of course, people change over time. There's this theory in psychology that I love called the end of history illusion, which basically says that people are keenly aware of how much they have changed in the past, but they don't think they're going to change that much in the future. I am a totally different person than I was 10 years ago. But if I try to forecast who I will be 10 years from now, I think I'm going to be the same person, but I won't be. We underestimate how much we'll change. And for financial planning, this is really important because it is a plea, I think, to avoid the extreme ends of financial planning. If you are an extreme saver or an extreme spender, living for the moment, the extreme ends of what you're doing just lead to a higher degree of regret in the future because you're going to change. So it's easy today in the moment to say, this is who I am. I want to spend every dollar that I make because you only live once. Let's go for it. Those are the kind of behaviors that's not necessarily wrong to do, but you are more likely to regret in the future. So when you realize how much people change, it just kind of pushes you towards a median, modest, balanced financial approach to the decisions that you make.
Right. Thank you very much, Morgan, for that. You've spoken about getting rich and staying rich. We work with many clients where we have to deal with intergenerational wealth transfer. So how important do you think is transmitting the wealth in an orderly manner? Because this is a subject which you've not written much about. So I wanted to pick your thoughts on it.
Yeah, no, it's really interesting. I have not written much about it, but it is very important, of course. And to me, I think what is most important in this topic is one, every family is different and every heir is different, has a different personality, different goals and desires and whatnot. So there's no one size fits all advice. But I think if there is something that I would recommend in this situation, just because I've seen it work so disastrously when this is not done, is to try to have wealth transferred early on in that person's life. That might seem counterintuitive to start giving money to a young person, but I think it is so important for the person who is receiving money to learn their mistakes early on. It's like if you are learning if you are making investment mistakes in your teens and early 20s, and you don't have very much money, then that is a much better way to learn than to inherit a bunch of money when you're 50, have no idea what you're doing, and then lose it all in your 50s when you need that money. So I think it is really important to, not 100%, not all of the money, of course, but if you can start giving money to people when they are young, or start having kids who are earning money when they're young, learn their investing mistakes when they are young. Because investing, again, there are a lot of parts of investing and finance that cannot be taught. You can't just sit down and teach someone. They need to learn those mistakes themselves. They need to know what it's like to lose money day trading in the stock market. That's an important lesson. They need to know what it's like to get in over your head, to exceed your budget. That's an important lesson that will stick with you that cannot be taught any other way. So I guess my only thought on transferring wealth and maintaining wealth is just making sure that the most important money lessons are taught firsthand and at the earliest age possible.
Right. The other very interesting chapter which I found in your book was how people have different outlooks towards investments based on their own personal history. In our field, we meet investors of different generations, and sometimes you get perplexed how one investor loves a particular asset class and another investor hates that asset class. And
Yep.
you explained it very beautifully in your book, where you say that it's all about what you've experienced in the beginning of your life or career. Could you elaborate
Yes.
on that, please?
So of course, we all have different experiences. And what I have experienced in the economy in the United States, as someone who was born in the 1980s, would be very different from what someone in the United States who was born in the 1950s or 30s experienced. And what we have all experienced in the United States is very different from anything you have experienced in India or someone has experienced in Germany, China. Everyone has a different view of the world based off of their own unique experiences. And those views have a big impact on how we think about the future. All anyone does when they're thinking about the future is they take the mental model that has been given to them based off of their life experiences, and they try to use that model that they've built based on their experiences and think about the future. So if you think about someone who grew up during the Great Depression, they're going to think about risk and debt and the stock market in very different ways than someone who grew up during a prosperous time. One example that I use in the book is this. If you were born in the United States in the 1950s, in 1950, then during your teens and 20s, your young, impressionable years where you're learning kind of a foundation of knowledge that will stick with you for the rest of your life, the stock market went nowhere adjusted for inflation, 0% return during your teens and 20s. If you were born in 1970 in the United States, the stock market increased tenfold during your teens and 20s, an incredible return. That's stuck with those generations for the rest of their life. This stays with people. It influences how they think about risk. And we saw this in the United States about 10 years ago when gold as an investment became very popular after the financial crisis, when the Federal Reserve was printing a lot of money. And what generation gold was most appealing to during that time was not my generation. I've never experienced inflation in any meaningful amounts. It was my parents' generation who came of age in the 1970s when inflation was very high in the United States, which is something that I can read about and try to study, but I don't have the emotional scar tissue that people who dealt with it did. So it's very different. That has a big impact on how we think about finances. And very often, when you have debates in investing or arguments in investing, it's often not because two people actually disagree with each other. It's just that they have a very different view of the world, different goals, different desires based off of their own unique circumstances. The big important takeaway for that for me is everyone is different. Everyone has different goals, and therefore everyone is going to do different things with their money. So an asset allocation that might look crazy to you might make a lot of sense to me. And that's okay. We should just embrace that we might be different people. Everyone is a different person and everyone has different goals. And there's no one size fits all answer. But it often is viewed in finance as it should be. Finance is often viewed as a math-based field. And 2 + 2 = 4 in India and in the United States and 100 years ago and 100 years from now. It's one answer. Finance does not work that way. Different answers for different people that we need to embrace.
Fantastic. Just to quote something from your book, you said personal finance is more personal than finance.
That's it. It's, of course, we're dealing with finance and there are financial rules and laws that we need to obey and respect. But this is a personal thing. I sometimes think the closest analogy to investing is personal relationships, like your spouse, your marriage, your boyfriend, your girlfriend. That tends to be the closest analogy because oftentimes it's different for everyone. What works for you might not work for me. Everyone has different desires, and that's okay. You just embrace what works for you, and that's fine.
Right. So, Morgan, let me dig into some of the questions posted by our listeners here. So first question, which is repeated a few times, is how does one prepare for risks that cannot be envisaged, like COVID-19?
I think, the two ways to deal with it, there's two things to keep in mind in terms of specific actions that you can take. The first is what I spoke about in the slides earlier, and just having expectations about the future. If you look historically, the world breaks in a very meaningful way about once per decade. COVID-19, the 2008 financial crisis, September 11th, you go on and on throughout history, World War II, the Great Depression, every 10 years, things tend to fall apart. If you just include that as your baseline expectation for what's going to happen in the future, then it kind of pushes you towards, again, more room for error, a higher savings rate, less desire for debt, those kind of things. If you just assume that there's going to be a constant chain of problems in the future, especially at the individual level and the country level, it's usually at least once a year, or definitely once every 2 or 3 years, that you face a big problem. And so it's important to realize that those problems, those breakages, those setbacks, recessions, and bear markets do not preclude long-term growth. So you can have the short run be a constant chain of problems and still do very well in the long run, which again just pushes you towards just really respecting room for error. The second thing that you can do as an individual to help think about problems that you cannot foresee is realizing that you do not need a reason to save money. A lot of people will say, well, are you saving money to buy a new house? Are you saving money to buy a new car? Are you saving money for retirement? I've often thought, no, I'm just saving for a world that is constantly uncertain, that I don't know what's going to happen in the future. That's what I'm saving for. It's not any specific goal. It's just saving for room for error, giving myself options in the future. Realizing that every penny of debt that you have is a point in the future that somebody else owns, a point of your time in the future that someone else owns. And every dollar of savings that I have is a period in the future that I own myself, that I can give back to myself. So if you just if you respect and accept that the future is so uncertain and a constant chain of problems, then again, it just pushes you more towards really desiring that room for error and saving for things that you cannot yet foresee or think about.
Right. Thank you. So you spoke very beautifully about time in markets. I mean, where you explained that Buffett made $84 billion after the age of 65. So time was a very big factor in his wealth creation journey. However, people have regrets. I mean, for example, if you compound 10% for 50 years and you compound at 15 or 20% for 50 years, it means a massive difference in wealth because of compounding. So how does one reconcile with that? I mean, yes, time is important, but people also want to chase high returns because even a couple of percentage point extra in terms of compounding is a massive difference. So how do you reconcile with this?
You're hinting at a very important point in finance, which is, I think, the most important financial skill, but also the hardest financial skill, is getting the goalpost to stop moving. So of course, if you earn 20% annual returns, you'll do very well, and compounded, you'll become extremely wealthy. I think the key to being happy with your money, though, is adjusting your expectations. And sure, it would be great if you could earn 20% returns, but you're going to be much happier if you say, look, if I earn 7%, I'll achieve all my financial goals, and that's all I need. The only way that you can become happier with your money is if your expectations and your desires grow slower than your income. So aiming low and having the lowest desires that you have, keeping the goalpost from stop moving, is not a really appealing or sexy thing to do for people. But if you think about it, it is the only way to become happy with our money, to gain happiness and pleasure from our wealth, is to make sure that our income grows faster than the goalpost, than our expectations. Really important thing to do. That's how I would say, that's how I personally adjust it. Look, I am a passive investor. I invest in index funds, but that's not because I don't believe in active management. It's not that at all. I have a lot of respect for smart investors who are going to do very well over time. And I'm close friends with a lot of them. The reason I'm a passive investor is because I know that if I just invest in index funds for the next 50 years and I never touch them, I'm going to achieve every financial goal that I have and then some. And so I don't have very much desire to do that much better than that. If there's one thing that I'm proud of that my wife and I have done, it's keeping the goalposts from stop moving. We've kept our expectations low, which means that the money that we do accumulate just feels that much better than if our expectations were much higher.
Right. Wonderful. So there are a lot of questions on the current state of global economy and markets. Would just love to get your thoughts on them. There is a worry that Fed and US has unleashed a lot of liquidity, and there seems to be a disconnect between markets and what's happening in the real economy in terms of jobs. And there is also a worry of inflation sometime in the near future. So how does one think about these things?
I definitely think that we have globally the highest risk of inflation now and in the coming few years than we have at any point in probably the last 40 years. The reason is this: if you look historically at what tends to cause inflation, it is not necessarily too much money. That's one side of the equation. What tends to cause inflation is too few goods. That's what, so that's the formula for inflation: too much money chasing too few goods. It tends to be the too few goods side of the equation that really causes problems. If you look at historical examples of high inflation, it tends to be after world wars, when your factories have been bombed to rubble and you can't produce goods anymore, or in nations where the central government has seized private assets, Venezuela and Zimbabwe, where your production of goods declines. It's the decline of goods that tends to cause inflation. And we are, with COVID-19, we're seeing a lot of industries that are broken, particularly in travel, restaurants, hotels, airlines, that are shutting down for good. They're not coming back. And then so if you were to have in 2021, let's say there's a vaccine and COVID-19 is over, let's cross our fingers, you're going to have a lot of people that want to go traveling, go on vacation, go on holiday, go back to restaurants. But if a lot of those restaurants are closed because they couldn't survive 2020, if a lot of the hotels have closed down because they couldn't survive, that's when you're going to have a lot of money chasing too few goods, lower supply. That is when you could have a lot of inflation, particularly in some specific industries like travel, hotel, airlines, restaurants. That's where I think you're going to see a lot of inflation. The forces right now in 2020 and this day and this moment are towards deflation because the economy is so hurt. It's much closer to something like the Great Depression or 2008, where there's just not enough demand. Everyone's staying home. No one's going to the restaurants. That's conducive to deflation. It's as we look 1, 2, 3 years out that I think we could get into problems. So then the question is, how do I deal with that as an investor? And I say, how do I deal with that? Because everyone's different. Everyone has different views on this. When I think about inflation, I've never been that interested in gold or Bitcoin. What I'm interested in protecting my assets over time is owning real quality businesses. I do that through owning stocks. That's what I think is going to protect inflation over time. Companies that can raise their prices with inflation. And then so if there is inflation, those companies' revenue, their profits are going to increase in lockstep. Historically, that tends to be one of the best inflation hedges. And also, I would say, how do I deal with the threat of inflation? It's in my expectations as well. Let's say we have a bout of inflation next year and the stock market falls 20% because of it. That's well within my expectations of what is a normal course as an investor. I know that's not going to preclude me from earning good returns over the next 10 or 20 years. So I own the stocks to help guard against long-term inflation. But if inflation is going to cause havoc in markets over the next coming years, I'm not even trying to avoid that. I just try to endure it and accept it and realize that if I can endure it, then over the long term, I'm going to earn some of the highest returns that I can. Charlie Munger's great quote on compounding, he says, the first rule of compounding is to never interrupt it unnecessarily, I think falls in this bucket. I don't want to interrupt my investments, even if there is inflation in the future. I just want to let them run, let them go, and do their thing over a long period of time.
Fantastic. So another connected point, pessimism is seductive and it also is very intellectual. So how does one stay away from this seduction of pessimism? And you talk about something called being reasonable versus rational. So if you could just elaborate on both these points.
So I think generally in a lot of areas in life, seduction is much more appealing to people pessimism is much more seductive than optimism for people to deal with. The reason is simple. It is that pessimism sounds like someone trying to help you. If I say, hey, there's a big threat in your future, there's something chasing you, it's going to hurt you, it sounds like I'm trying to help you. Versus if I come to you and say, hey, I've got a big opportunity for you to get rich, I sound like a salesman. I sound like someone trying to sell something to you. So it's much easier to pay attention to the pessimists because it seems like they're trying to prevent you from harm. And the other thing that's really important in economics is that there are no overnight miracles in the economy. Progress in the economy happens slow. It takes place over 5, 10, 20 years. That's where growth compounds. But there are overnight tragedies. COVID-19 is basically an overnight tragedy. September 11th was an overnight tragedy. So the setbacks happen very quickly, even though the growth happens slow. The growth is more powerful than the setbacks over time, but it happens slow. Therefore, in any given day, any given month, any given year, what is tend to be in the headlines, the news tends to cover, that we tend to pay attention to, are the setbacks, just because they happen quickly. They happen so fast that we can't help but pay attention to them, whereas progress happens so slow that it's hard to pay attention to. That is where optimism and pessimism really comes from. I think as an investor, how I deal with this, again, this ties back to some other things I've said earlier, is just realizing that I need to save like a pessimist and invest like an optimist. I expect as my baseline scenario that as we go through the economy, not just this year, but in the next 5, 10, 20 years, there's always going to be something going wrong. There's always going to be policymakers making bad decisions. There's always going to be recessions. Companies are going to be going out of business. There's going to be frauds. There's always going to be risk in front of us. And that's fine. I just accept that that's what it's going to be, that there are going to be periods where I lose 20% of my money in a year, 30% of my money in a month, like we did in March of this year. And that's within my expectations. I think, so again, that is just a psychological shift. I'm not telling you, here's how you deal with it. Go buy this asset, go buy this stock. That's not what I want to do. To me, it's just a shift in your expectations, a shift in your psychology, and realizing that there can be a lot of pessimism in the short run that does not preclude long-term optimism. If you look at the last 100 years in the United States and around the world and in India, tremendous amount of economic growth and progress. But at any given point during that period, any point, there are no exceptions to this. Pick up a local newspaper from 10, 20 years ago, always pessimism in there. That's always going to be the case in the future as well. I think it's just a normal part of how we think about risk.
Right. Some of the other questions which I'm getting, Morgan, are on valuations. And people want to know about your allocation. I mean, you've written about it, but it'll be nice if you could tell us how you allocate your money. And the second point is, do you rebalance your portfolio ever? I mean, if let's say markets are trading at elevated valuations, do you rebalance? And if let's say, we've had an event like COVID where markets corrected about 30-40%, do you increase equities in your portfolio? How do you work it out yourself?
Sure. So the first thing, the first disclaimer that I need to make is that I'll tell you what I do with my money, but I'm not recommending other people do that. This is what works for myself and my wife, but since everyone's different, this is not advice. And I don't just mean that from a legal perspective. I think it's really important to realize that just because I do it doesn't mean that that even I think it's right for you. So what I do with my money, I've written about this. It's so simple. I can explain our money in 3 seconds. We own this house, a checking account, and some Vanguard index funds. And that's it. That's as simple as our finances get. I dollar cost average into the index funds, which means every paycheck, every 2 weeks, I put the same amount of money into the index funds. And I do that consistently. And that's it. That's all I do. The asset allocation, cash as a percentage of our net worth, it always depends how you measure it, but it's reasonably high. It's probably something like 20% now, something in that neighborhood, which is about where I want it. Do I rebalance when the market does very well? No, I don't sell when the market does very well. If it declines a lot, like in March, then my dollar cost averaging contributions will go up a little bit. I will put more money in there as it declines. I don't really have any firm metric or strategy for that. It's just kind of, hey, the market's declined 20%. Let's put a little bit more in. It's just kind of something that I do haphazardly, I would say. And my plan is to be able to hold those. I'm 36 years old. So if I can invest for another 50 years, if I can do that, if I can dollar cost average into a diversified index fund and hold it for 50 years, I'm going to achieve every financial goal that I have. So I don't feel any desire to make it more complicated than that. I know, this might sound like a weird statement, but I know with certainty that I could earn higher returns with a more complicated investing strategy, but I don't. Why is that? Does it seem hypocritical? To me, it's just, again, it's keeping your expectations in check. If I have high certainty, the highest certainty that I can achieve all my financial goals doing something simple, I don't have any desire to make it more complicated than that. And earning higher returns doing something more complicated, I would put in the same bucket as, saying that I could earn more money if I got a second job, but I don't want to do that. I'm fine just having one job and doing what I do. So that's what I do with my money.
Right. And how do you think about emerging markets? Do you have any index funds which allocate in emerging markets?
So what's interesting when you own stocks in the United States, this tends to be true everywhere, but especially in the United States. If you own U.S. companies, you look at the S&P 500, half of S&P 500 revenue comes from outside the United States. So even if I primarily own US companies, they are global by nature and they do a lot of business in emerging markets. I do own some international funds that are within there that do own that. But here's one thing I'll say about emerging markets around the world. All economic growth can be explained very simple. It comes from 2 things, excuse me, population growth and productivity growth. That's where all economic growth comes from. You can either increase the number of people you have or make those people more productive. That's how you grow an economy. If you look at the global economy over the next 30 years, there are a lot of very important demographic trends that impact the population growth side of that. If you look at China or Japan or South Korea or Europe or Russia, all of those major economies have declining working age populations. China is declining rapidly. Their working age population, which is the population of people age 16 to 64, is set to decline by 200 million workers by 2050. There is no history on this planet of any economy growing while their population is declining. It's never occurred. But if you are to look at what parts of the globe actually do have good demographics, where there is going to be population growth that is going to propel the economy, it's India and Africa. Those are the regions. We have decent demographics in the United States, but not as good as it was over the last 100 years. But it's still going to be growing just very slowly. India and Africa are the only areas of the world that have good economic infrastructure that also have good demographics. If you were to just think about that one metric and think about the next 30 years in the global economy, that would be something where I would say those are the regions that I would be most optimistic on, just by that one metric, leaving aside any sort of technological progress or innovations or what happens in terms of political growth, political interference. Just on that one metric that we can put a lot of emphasis into, a lot of confidence into, those are the areas that I would be most bullish on.
Right. I think that answers one of the questions that I see in the Q&A box, where a gentleman is asked, how does dollar cost averaging work in a country like Japan, which is in a multi-decade bear market?
Yep.
So there again, you see the seduction of pessimism.
Well, and here's what's interesting about Japan. It's a really fascinating example because, of course, for those who don't know, the Japanese stock market is lower today than it was 30 years ago. So a large developed nation, and you've earned nothing over a full lifetime. So how does that go against what I do? One is that, of course, it is possible that the United States ends up the same way. Is it possible that 30 years from now, the US stock market is lower than it is today? Yes, of course. If it happened in Japan, of course it can happen here. What's interesting about Japan are two things. One, the demographics that we just spoke about have been dismal in Japan. So their population has been either flat or declining for a long time in a way that it is not in the United States, definitely not in India or other parts of the world. What's really interesting to me about Japan, though, is that the last 30 years in the stock market have been zero. They've earned nothing. The 20 years before that, if you look from 1970 to 1990, it was the highest returns in any stock market in the history of this planet. Just ridiculous, incredible returns that you earned from 1970 to 1990. So it's not necessarily that Japan has had 30 years of no returns. Of course, that's what's happened. But I think the bigger context is that they front-loaded 50 years of returns into a 20-year period from 1970 to 1990. So look, if you started investing in Japan in 1970, your average annual returns today are pretty good. Of course, that's not how it works for everyone. If you started investing in 1990, you have a very different result. But I think that just goes to another point of it's important to understand the history of volatility. It means that sometimes returns are front-loaded into a period and sometimes they're back-loaded. They're never spread out evenly. So the reason Japan's stock market has done so poorly is just because so many of the returns that came from its productivity and its innovations that has had a lot of in the economy just got front-loaded into that period. One final way I would say to summarize this is to say, look, the Japanese stock market has been stagnant for 30 years, but the Japanese economy has done pretty well. If you go to Tokyo, it's beautiful. It's been a lovely place to live. The highest unemployment that they have had in the last 30 years is 5.5%. So the Japanese economy has done very well. Its stock market has not, just because the returns came during that crunched up period in the 1970s and 80s.
You make a great point there, Morgan. So I remember after 2000, NASDAQ didn't deliver positive returns for 12 or 12 years, 12 or 13 years. So I think the same phenomena played out in NASDAQ as well. So my question is, do you think the FANG stocks and Tesla, etc., or the NASDAQ today is in a situation which could be similar?
I think it easily could be. I'm not going to make a prediction about where it's going to go in the next year or even 5 years, but it's also true that those companies have done very, very well in recent years. It's also true that it's not just their stock prices that have done well; their businesses have done well. If you are Amazon, your business has surged this year because of COVID-19, and your market share, your stranglehold over the market that you are working in, has grown. Same with Google and Facebook. Those companies have a lot of economic advantages. And in a zero interest rate world where there's no competition for your money from bonds to put it in, a lot of people will look at those strong companies, Amazon, Apple, Google, Microsoft, Facebook, and say, that's where I want my money. Tesla's a little bit of a different story because it's not a good business. It makes a good product, but they're not a good business in the way that Apple and Google are. Tesla might be a different story. And of course, Tesla's run up has been absurd. I think it's up, 8-fold this year, something like that. So that might be a different story. There's a lot of speculation going on there. But I do think it does make some sense that you would expect the FANG stocks to not only do better, but do it much, much better than what it looks like is going on in the average economy. If you look at what's going on Main Street in the United States and around the world, restaurants, dry cleaners, auto repair shops, of course, they're having the worst economic go that they've had since the Great Depression. It is truly as bad as it's been in 100 years for those industries. But if you are Amazon or Google, you're doing better than ever. You can run your entire business with your employees working from home. There hasn't really been any impact to your business other than you have a lot more people who are looking at your products and need your products right now. So it makes sense that those companies are doing well. But in a diversified portfolio, of course, you're hedging against that. So even if those companies don't do well or if they pull back a little bit, if you're diversified enough, it doesn't make that much of an impact.
Great. So Morgan, India is at a very interesting juncture today. I mean, our per capita is close to $2,200, and going by the current nominal GDP growth rate, it's quite possible that we could easily double in the next, let's say, 7 or 8 years, right?
Yeah.
So what I find fascinating about the section which you've written towards the end of the book is the history of the entire consumption boom in the US. And the financialization of the economy. So could you talk to us about that? Because a lot of us here believe that India could be at the cusp of such a period.
Yeah, so the postscript of the book is kind of the history of the U.S. economy. And let me try to summarize it really quickly and succinctly. At the end of World War II, policymakers thought that once the wartime spending was over, that we were going to slip back into the Great Depression that hit us in the 1930s. They combated this by saying at the end of World War II, they said, we're going to give returning soldiers lots of money. We're going to give them money to buy houses. We're going to give them money to buy cars and washing machines, whatever that. We're going to give them a lot of money, make it easier for them to spend. And that sparked a big consumption boom. And what was really important about that consumption boom is that the rich people and the poor people, kind of the whole economy, everyone kind of grew together during that period. There were richer people than poor people, of course, but the growth rate tended to be on the same track. And they would tend to be living very similar lives. They drove similar cars. They lived in similar neighborhoods. They watched the same TV shows. They watched the same news stations. They were very similar. Around 1980, people started growing apart. And you had a big boom in wealth inequality, where most people's incomes, stayed flat, stagnated, and wealthy people's incomes surged. And that's been the biggest trend of the last 30 or 40 years. That was a really important part of the sociology of the history of the United States, because for most of the post-World War II period, people thought that they deserve to live a similar life as their neighbor, because everyone was kind of growing in lockstep. So if your neighbor drove this kind of car, you deserve to drive that kind of car. And if your neighbor lived in a big house, you deserve to live in a big house. Everyone was kind of going in the same direction. But as wealth inequality started pushing people apart, the only way that the average American could keep up with the wealthy American who was buying bigger homes and bigger cars was to close that gap with debt. That was the only way that they could close that gap. If your neighbor was suddenly lived in a 4,000 square foot house, well, then you want to live in a 4,000 square foot house, and you have to finance that with debt. If they're sending their kids to expensive private schools, you want to do that too, and you've closed that gap with debt. That began the big debt boom. We had a consumption boom, and then it began the big debt boom that led us to 2008 and the financial crisis that was caused by too much debt. And I also think that things like Brexit, the rise of Donald Trump, those kind of things have their roots in that. You have a large subset of the economy, particularly this is true all over the world. A large subset of the economy who doesn't think that the last 30 years has worked for them. It hasn't worked. It's worked for some people. Some people have gotten very, very wealthy, but the majority of people haven't. So it's not necessarily surprising that you have a lot of majorities of these countries, or not necessarily majorities, but very large portions of these countries who say, I want something different. This isn't working for me. I want something different. I think that's the roots of Brexit, roots of Donald Trump. It all kind of started in this consumption and then debt boom that began at the end of World War II.
Fantastic. Morgan, you finished writing your book in January this year. Post that, we had the COVID crisis hit markets. What kind of long-term habit changes or structural changes do you see in the economy going forward? Any themes that you particularly are watching or any trends that you find interesting?
I think what's so interesting about this is that, unlike, let's use World War II as an example again. If you lived in the United States or the UK during World War II, it affected everybody. You were either a soldier or you were working in a factory that was working for the war. Everyone was involved. So there tend to be there was a common enemy. Everyone was on the same team. Everyone was in the same circumstances. COVID-19 is very different because everyone's not in the same circumstances. If your ability to work from home and do well is heavily dependent on how much money you make and how much education you have. By and large, in the United States and around the world, the poorest people who do the manual work are out there still working, or they've either been laid off or they have to go to work where they're susceptible to COVID-19. Whereas the wealthier people get to stay home and do their jobs from home in safety and keep earning their paychecks. So people have very different circumstances right now, and they've had very different experiences with it. So what COVID-19 is going to do to people is going to be very different. I think if you are someone who lost their job, who lost their business over the last 6 or 8 months, it's going to stick with you for the rest of your life. Very in the same way that the Great Depression scarred a generation that didn't want to go into a lot of debt, didn't want to take a lot of risk with their investments. There's going to be probably half the global economy that falls into that bucket. Will stay with them for the rest of their life. The other half of people who have done well over the last 6 months and will continue doing well, that subset of people, I don't think it's going to necessarily have that much impact on them because it's COVID-19 for a large portion of the economy. This seems like it's out of touch to say this, but it's true, has been nothing more than a nuisance. Even though it's been either devastating, completely changed your world, or it's been a mere nuisance. People just experience it very different. So I think they're going to have different experiences and expectations from that. If there is one thing that I think is going to impact a lot of the world, the United States, probably India as well, is a higher demand from governments of a social safety net. Because when you go through something this jarring, this tragic, you just have more people in the economy, more voters from both political sides who say, I want to protect my downside risk, and the government is the only organization who's capable of doing that. We've already seen that in the United States and around the world. I think that's going to be a growing trend in the next 5 or 10 years, very similar to it was after the Great Depression and World War II.
The other trend we've seen over the last decade, Morgan, is a lot of new businesses have been funded by private equity. In fact, many of them have grown without going to the market and raising funds. Even in India, we've seen a lot of the new age businesses or digital businesses being funded by private equity money, and they've not had to come to public markets. Do you see that trend continuing?
I think it will probably continue just because a lot of times being a private company is easier than being a public company. You don't have to deal with the day-to-day volatility of the stock market. You don't have to deal with the reporting and the spotlight requirements that are put on you if you're a public company. You can just kind of live in anonymity as a private company. And as there's more money doing that, and if private investors think they can earn higher returns doing that, there's going to be more of that. So I think that's definitely going to stick around. There are advantages. It's not that public markets are going to die or go away. There's always going to be benefits to big companies going public. They need to do that to gain liquidity for their investors and their employees. But is it going to be less than it was 30 years ago? Yes, I think that will be the case. It is also true that there's so much money in private markets today that the relative advantage that they had 20 years ago, by and large, does not exist anymore. It used to be 20 years ago that private equity firms could just mint money. It was easy money because there was so little competition for what they were doing. There's so much more competition today that returns might converge onto to public stock market returns. But that's definitely a trend that will not go away anytime soon. Yeah.
The other thing that we've witnessed, Morgan, over the last decade is this bipolar nature of markets, where a lot of the so-called traditional value investors have not made money for a very long time or have lagged the indices in a very big way. So how do you think about this growth and value investing?
I think if you look at the long history of markets over 100 or 150 years, that shift, the trade-off between growth and value has always existed. It always goes back and forth. There have been periods, the periods usually last 10 or 15 years, not always, but in general, where either growth does well or value does well. Or also you can break up a trend and say, if you look at the last 50 years, it usually toggles between European stocks doing well or United States stocks doing well. They usually don't do well at the same time. They usually trade off back and forth. So that's always existed, that trade-off back and forth. What it really comes down to, for me, the reason that growth has worked and value has not is just interest rates. When interest rates are high, value investing is popular and appealing. And when interest rates are low, value investing is not appealing at all. And growth is very appealing. Just if you think about like an average discounted cash flow model, I don't want to get too technical here, but if interest rates go to zero, then it puts a greater emphasis on stories of what the future could be and less emphasis on what the present actually is. That's the biggest change in what happens. When interest rates are high, then stories about the future aren't that meaningful. What happens today is meaningful because you have so much competition for your dollars among bonds and bank accounts where you can earn a good return when interest rates are high. When they go away, then it's just stories about the future that become most powerful. And that's why Tesla can rise 800%, even though they're not profitable. That's why these growth stocks are doing so incredibly well when value stocks have gone nowhere. Is that it's just a shift between the importance of what reality is today and what the future might be tomorrow changes over time. That's always been the case. So even though it's powerful right now, I don't think it's any kind of change in what we've seen historically.
That's a very, very valid point. Morgan, what personal habit changes have you seen during this COVID period? I mean, how have you adapted during this period?
So I feel kind of lucky and almost guilty in a sense that I've worked from home my entire career. So this is nothing new to me. And also my children are not in school yet. They're too young for that. So we don't have to deal with that end of it either. So not much has changed for myself or my family. I think if there is any, big lesson for me in 2020, it's just the reiteration that risk is what you don't see. I had a breakfast with a friend in February where we talked about, and I laugh because it just seems so ridiculous in hindsight. We talked about the idea that there might not be another global recession for a decade or more. And this was in February. The global recession was days away. So I think that kind of thing is always humbling to think about. That risk is what you don't see, and we have no idea what the future holds for us. That too is not comforting to think about. But if 2020 does not humble your ability to predict the future, then nothing will. It's been humbling for everyone, of course.
We always put knowledge first. So wanted to know which are the most important books that you've read, apart from your own book as well.
See, I'm sure you've heard me speak many times about this. I love the period that encompasses the Great Depression and World War II. Because I think that is a period in modern history that is very well documented, in which people dealt with the most amount of uncertainty than they ever have in any other period in modern history. More uncertainty, more tragedy, more trauma, more opportunity, more risk, et cetera, than has ever existed. So I love studying that period and just trying to understand. Of course, I didn't experience it, but try to understand what was going through people's heads. What were they thinking? What did they think about the future? What did they think about threats and opportunity? How did they deal with the threats? What did they do wrong? What did they do right? So much took place during that period that I love. So basically anything about World War II. Two books that stick out from that period. There's a book called The Great Depression, A Diary, which is a diary that was written by a lawyer named Benjamin Roth that he kept during the Great Depression, where he just writes about what was going on in his local town, how the Great Depression was hurting businesses and people, what they did with it. It's a wonderful diary that his son published about a decade ago. The best book on World War II, I would say, is probably a book called Guns at Last Light. That is just such a fascinating read.
Could you repeat that?
Yes, it's called Guns at Last Light.
All right.
And so it's by a guy named Rick Atkinson, and it's just such a good read, a good narrative about what World War II was like, the uncertainty, the trauma, the pain, the suffering that took place during it. Really had a profound impact on me.
Lastly, but not the least, Morgan, I mean, we've been made aware of all our biases by many of these, behavioral scientists. I mean, we have had Kahneman, Ariely, Taylor. Which among the biases, which would be the top three biases for you? If we were to overcome, we would become better investors.
I think, it's really important that the last part where you say to overcome it. The most important bias for me is assuming that you can overcome your biases, because I don't think most people can. Daniel Kahneman, who won the Nobel Prize in economics for his work in biases effectively, that's his specialty, has been asked many times, Dr. Kahneman, you won the Nobel Prize in this work. Have you yourself personally been able to overcome your biases? He says, no, not at all. So if someone like he can't overcome them, then I don't think people like myself or anyone else has any chance of doing it either. For me, it's rather than trying to overcome my biases, I try to embrace them and just realize that this is who I am. And I can't fix who I am. I can't change who I am, but I can just accept who I am and then have an investing strategy that works around that rather than trying to break it. That's what I do for myself. So I have my own personality quirks, my own financial goals that fall into that. And I just accept that that's who I am. So I think the biggest thing that people can do, the biggest takeaway, is just try to be more introspective about yourself. Figure out who you are, your own goals, your own biases that are going to be different from everyone else, even different from your spouse, different from your friends, different from your family, and just embrace that. And to use a phrase to finish today that you brought up earlier, that is my favorite phrase in finance, personal finance is more personal than it is finance.
Fantastic. That's a very good note to end on, Morgan. It's been an amazing 70 minutes. And we can go on and on, but thank you very much for being with us today. Evening, morning for you. The book is a fantastic read. I have finished the book thanks to the pre-order copy that you sent me. But I would urge everybody who's watching to pick up a copy of Psychology of Money as quickly as it hits the bookshelves here in India. It's a very good read. So thank you very much, Morgan. Thank you
Thanks
very
so
much for
having
being
me
with us. Yeah.
It's been an honor to speak with you. Thank you again. I appreciate it.
Yeah. Thank you. Thank you. Thank you for joining us. And yeah.